Students, hi, Catherine Robertson here. Week 4 of our 101 course. There are 2 chapters, chapter 7 and 8 for this week, and various videos for this week. There's also a homework assignment this week. There is no discussion post this week for the class. Okay, so let's look first at chapter 7, entrepreneurship. And so the chapter 7, once you have read that in the textbook, and if you are reviewing the PowerPoint, or if you have been reviewing the PowerPoint, one of the things that we think of when we think of entrepreneurship, which is a whole section of courses here at EC3, people may go into opening their own business for multiple reasons. Sometimes it's because of survival, because maybe they lost their job and they need to have a job, or maybe they need a second job, or maybe they want to move somewhere where there aren't a lot of jobs. Another reason might be for a challenge. Some people like the challenge of opening their own business. Others like flexibility of owning your own business, the independence, and ultimately financial success. Working for somebody else is wonderful, but working for yourself is really a way to ensure that you control how much money that you can make at any given point. So some of the characteristics of an entrepreneur or entrepreneurial attitudes that we see are this idea of being self-reliant, having energy, confidence. One of the biggies is also a tolerance for uncertainty. And again, these are things that if maybe you don't possess right now, you might have interest in kind of like gaining those skills, becoming more self-reliant, becoming more energetic and confident, and growing your tolerance. So as you're reading chapter 7, make sure that you're thinking about some of the things that are important to you, and you think about what it means to be an entrepreneur. Whether you believe that you have an internal locus of control or an external, meaning that things happen from the outside that you have less control over, versus if you have more of a feeling like you control your destiny. We all have both of those happening, but we can really try to focus on more. What are the things that we can do to control, what happens in our lives? So entrepreneurs are very good at doing that. And so when we're thinking about starting small businesses, the SWOT analysis is very important. Thinking about some of the opportunities that are out there externally, also some of the threats that we might be facing as we're opening a new business, or maybe as we're expanding a current business into other areas. The other thing that's important, and these links are available to you, the Small Business Administration, the SBA, but also the SBDC. Both of those things are part of what is important during this chapter, and also developing a business plan. So those links are all available to you. If you look in the, course-specific materials, you will find some links to the Small Business Development Center locally, and you will also find, actually I'll move those into week 4 so you have those, linked to the Small Business Development Center here in Erie, which is located in Gannon, and also the SBA.gov, which is our federal. So we have our local/state. We also have a federal, which is the SBA. And so those links are there for you to check out if you'd like. There are also there's 2 short videos, Creating an Entrepreneurial Mindset by, none other than my favorite, Simon Sinek, and also a video on SWOT analysis, and those 2 go along with chapter 7. Chapter 8 gets you a little bit acquainted with accounting. Those of you that have already had ACC 111, this will be a review, and really talking about, in chapter 8, talking about how accounting is this system for recognizing, organizing, analyzing, and reporting information. So as you're reading through chapter 8 of the text, really thinking about who uses accounting and how do we use it. Again, it goes back to that idea of organizing information that is coming into a business. So figuring out what are our expenses, where is our revenue coming from, and how do they match up? That's really this goal behind accounting. Individuals that use that information, managers, employees, but also in a publicly traded company, stockholders. We also see suppliers. They may look at your accounting records to see if they want to work with you. And, really thinking about how we organize the numbers for a company. And so we do that through a set of accounting principles, and this A set of accounting principles is known as the Generally Accepted Accounting Principles. GAAP, GAAP is the acronym, and the Financial Accounting Standards Board, the FASB, is the ones. They are the ones that are responsible for setting these standards, and these really are kind of the guidelines as to how you should be kind of crafting your financial statements for your company. The IRS also sets some standards for companies so that they know what they need to report and how to report it, so that companies properly pay their taxes, things that we all love. So a couple of the things when we're thinking about financial reports, we really are looking at this idea of assets, liabilities, and owner's equity or equity. So assets equal, your assets really are the resources, everything that the business owns. These are examples of these are cash, accounts receivable, property, intangibles like copyrights, and these. There's a short video on accounting that is will be very helpful to you. Also, and then what is the ownership of those? Is it the ownership of the business, or does somebody else stake claim? Like, is there some sort of loan on that ownership? And so that is really when we say assets equal liabilities plus owner equity or equity. That is really the gist of, that is the accounting equation that we use for all coursework. Revenues and expenses. Obviously, if you have your revenue coming in, that is not your profit. Your revenue is the money coming in, but from that revenue, your expenses need to be subtracted. The difference there, hopefully your revenue is more than your expenses, and so the difference then, that is your net income, and that is your net income / profit. So as you're looking through and then comparing managerial versus financial accounting in Exhibit 8.5, make sure that you have some clarity as to this idea of assets equal liabilities plus equity. So if you have a business that owns everything outright, say the business has $100,000 worth of assets, and there's no loans in the business, there's no accounts payable, you would have 100% of what the value of your assets are would equal all of your equity in the business. So say you own a house and your house is worth $80,000 and you don't owe the bank any money. You own it outright. You've paid for your house. It's done. Your house is worth $80,000. The equity that you have in it is $80,000. So if you sold your house today at $80,000, you would collect all $80,000 theoretically of that money. Now, if you have a loan on the house, like a mortgage, you own the house for $80,000. You have a $60,000 loan, and $20,000 was your down payment. If you sold that $80,000 house, you would not get $80,000 and walk away. You would have to pay the bank at $60,000 to pay off that mortgage, and you would get to keep the $20,000 equity, money that you have in skin in the game, essentially. So that is really why we have this idea of assets equal liabilities, whatever the loans are against the house or the business, and then the equity would be whatever is the remainder. And so once you finish those two chapters, there are questions there for you, homework from chapters 7 and 8, which is due next week. And if you have any issues, always, always, always reach out to me. You can text me 814-490-6473, or reach out to me via email, crobertson@ec3pa.org.